This episode is supported by AnalystKit.com. Thousands of tried-and-true calculations mixed with AI to find you the best stocks in a single click.
Hey everyone, welcome back. It seems like every day we hear a new horror story about those investment scams. People losing their life savings, their dreams. It's heartbreaking.
It really is, and unfortunately, these scams are more common than you might think.
Right, that's why I'm so glad we're doing this deep dive. Getting into the nitty-gritty of how these schemes work so our listeners can protect themselves. I was actually going through the articles and reports you shared, and wow, some of these tactics are seriously sneaky.
Absolutely. The scammers behind these schemes, they're clever, they know how to manipulate, they use psychological tricks, and then they throw in these complex financial products to confuse people. It's like a recipe for disaster.
It's like they're playing chess with your money, and most people don't even realize they're in the game.
Exactly.
Okay, so to unpack this, I thought we could break these schemes down into categories, kind of like a scammer's toolbox. But as we talk, remember, they often use tactics from multiple categories at once. It's rarely just one thing.
That's a really good point. It's never as straightforward as it seems.
Right. So let's start with a category that I think really tugs at people's heartstrings. Schemes that prey on your emotions and your trust.
Oh, absolutely. These are the ones that really get you because they target people who are hopeful, looking for a brighter future, maybe a little too trusting, which makes them vulnerable.
And that hope, that desire for a better life, it can make you susceptible to something that sounds too good to be true.
Exactly.
Like take advance fee fraud, for example. I used to think, come on, who actually falls for that? But reading through these stories, it's easy to see how people get caught up.
Oh, yeah. It's easy to judge from the outside, but these scammers, they're good at what they do. They target people, often overseas, with these promises of huge inheritances or incredible investment opportunities. But there's a catch, right? They just need a small fee up front to release the funds.
The old, we just need a little bit of your money to unlock your fortune trick. Classic.
Exactly.
But it's never just a small fee, is it?
Never. It starts small, but then there's always another fee, another delay, another excuse. And they create this sense of urgency, too, They might say things like, your assets are frozen or you're in legal trouble. Anything to pressure you into acting quickly without thinking.
Wow. So besides those obvious red flags, what else should our listeners watch out for? Like, what are some telltale signs that someone's running an advance fee fraud?
Well, a big one is cold calls. If you get a call out of the blue from someone you don't know promising you an amazing investment, that's a huge red flag.
Yeah, it's like that saying, if it sounds too good to be true.
It probably is. That's the one.
Exactly.
And along those lines, be wary of any promises of guaranteed returns. Investing always involves some level of risk. Anyone claiming otherwise is likely trying to pull something over on you.
So if someone calls with a can't-miss opportunity, best thing to do is just hang up.
Honestly? Yeah, hang up. Or, if you're feeling up to it, tell them you need to do some research and you'll get back to them. Then take that time to verify their legitimacy. If you're dealing with a broker, you can use Finar's Broker Check website.
Oh, yeah, that's a good one. And folks, make sure you're on the actual NRA website, not some fake one. Type the address in directly. Don't just click a link in an email. You can't be too careful.
Absolutely.
Okay, so we've covered advance fee fraud, which can happen to anyone. But let's talk about a scheme that might be particularly appealing to those nearing retirement. Advice to retire early.
Right.
I mean, it's the dream, right? Retire early, travel the world, enjoy life. Who wouldn't want that? But I'm guessing it's not always what it's cracked up to be.
Unfortunately, you're right. While early retirement is a fantastic goal, a lot of these schemes, they push people toward very high-risk investments, promising unrealistic returns.
So those promises of you'll make just as much, if not more, in retirement as you did while you were working, that's all exaggerated.
Most of the time, yes. They downplay the risks and might even make misleading claims about tax loopholes. And while loopholes do exist, they're often misrepresented and certainly don't erase the inherent risks that come with early retirement.
And I imagine early retirement, especially if it's unplanned or based on bad advice, it can really derail your long-term financial stability.
Oh, absolutely. It can be devastating. That's why it's so important to be cautious about any advice that seems too good to be true, particularly when it comes to something as important as retirement.
So if someone approaches you with an opportunity that promises early retirement, what are some steps you can take to make sure you're not falling into a trap?
Well, FINRA, they have 10 excellent tips for this specific situation, and one of the biggest ones is to be wary of those free lunch seminars.
Ah, yes, the classic free lunch seminar.
They're everywhere, and they're often used to lure people in, get them in the door with a free meal, and then bombard them with these high-pressure sales tactics.
It's like they say, there's no such thing as a free lunch.
Exactly,
Yeah.
especially when it comes to investing. So yeah, if you see an ad for a free seminar promising early retirement secrets, that's a big sign to proceed with caution.
Big time.
Another important tip is to be realistic about your risk tolerance. How comfortable are you with the idea of your retirement funds fluctuating?
Yeah, because you don't want to be gambling away your golden years.
Exactly. And if you are considering retiring early, know your current retirement plan inside and out. Understand the tax consequences of cashing out early and any potential penalties you might face.
And don't forget about those hidden fees. Always read the fine print, people. Make sure you understand all the costs involved before you even think about signing anything.
Absolutely. Transparency is key, and if someone's being evasive about fees, that's a big red flag.
100%.
Yeah.
Speaking of things not being what they seem, let's talk about those senior specialist designations.
Right.
I have to admit, this one really surprised me. I mean, I knew there were financial advisors who specialized in working with seniors, but I had no idea how many misleading designations were out there.
Yeah, it's a real problem. The Consumer Financial Protection Bureau, the CFPB, they actually did a whole report on this. Did you know they found over 50 different designations that target seniors? And many of them lack any real oversight or standards.
It's like the Wild West out there. So someone can just, put senior financial guru on their business card and start giving advice. That seems incredibly risky.
It is risky, and unfortunately, seniors can be more vulnerable to these tactics. They might assume that someone with a fancy title knows what they're talking about, but the reality is these designations often focus more on sales tactics than on genuine financial advice.
So it's less about helping seniors make sound financial decisions and more about just making a quick commission.
Sadly, that's often the case. They might hold these free seminars, offer to review your assets, and then steer you towards products that aren't in your best interest, all while hiding behind this veneer of expertise.
It's like a wolf in sheep's clothing. So if a so-called senior specialist approaches you, what's the best way to protect yourself? What should you be asking?
Don't be afraid to ask tough questions. What are their qualifications, really? Are they licensed? Have they had any disciplinary actions against them? And don't just take their word for it.
Right? Verify it.
Exactly. Check with your state or federal securities regulators. Look them up online. It's better to be safe than sorry.
1,000 times yes.
Hmm.
Never hesitate to double-check someone's background, especially when it comes to your finances. Okay, so we've covered schemes that prey on our emotions, our trust, especially for seniors. But our sources also went into schemes that use complex products, confusing jargon, to mislead investors.
Yeah.
I have to admit, I felt a little lost reading about some of these.
Oh, it's understandable. A lot of these products are designed to be complex. It makes it harder for the average person to understand the risks.
Like, for example, equity indexed annuities. EIAs. I've seen ads for those, and I'll be honest, I've always been a little intimidated to even try to figure out how they work.
Yeah. EIAs, they're a prime example of a product that sounds appealing on the surface, but there are a lot of potential downsides that they don't always tell you about in those flashy marketing materials.
Okay, so break it down for me. In simple terms, how do EIAs actually work?
Well, at their core, they combine a guaranteed minimum return with the potential for growth that's linked to a market index, like the S&P 500, for example.
So you get a little bit of that security, but with the potential for some upside if the market does well.
Right.
Okay, that sounds honestly pretty good so far.
Yeah.
So what's the catch? What's the downside that they're not mentioning in the ads?
Well, the catch, like with many things, is in the details. First of all, there are often hefty surrender charges.
Surrender charges.
Yeah, if you need to withdraw your money early, you could get hit with a pretty significant penalty.
So if you have an emergency, need access to your funds, you're basically penalized for it.
Exactly. It's not as liquid as it might seem.
Okay, good to know. What else?
Another thing to watch out for is that the guaranteed return often doesn't activate until after the account has been active for a certain number of years.
Oh, so you could be stuck in a low-yielding investment for a while before you see any of those big gains they promised.
That's right. And even then, those gains are often capped. So let's say the S&P 500 goes up 10%, but your EIA has an interest rate cap of, say, 6%. You're only going to get that 6% return even though the market performed better.
So they're putting a limit on your potential profits.
Exactly.
Sneaky.
It is. And then on top of all of that, there's something called the participation rate.
The participation rate.
Yeah. The participation rate is like you're betting on a horse that can only win a portion of the actual prize money.
So even if the market's doing great, your investment might not reflect that.
Unfortunately not. You're not fully participating in the gains. And of course, let's not forget about those administrative fees. Those can eat into your returns over time.
It's starting to sound like EIAs are more trouble than they're worth.
They can be, especially if they're not properly explained or if they're recommended to someone who it's not a suitable investment for.
So what's the takeaway for our listeners when it comes to EIAs or any other type of complex financial product for that matter?
Don't rush into anything. Thorough research is essential. Don't just take a salesperson's word for it. Read the fine print, compare different products, and talk to a trusted financial advisor to see if it aligns with your goals and your risk tolerance.
Like anything else, if you don't understand it, don't buy it.
Exactly.
All right. That was a lot to unpack with just EIAs, but we have one more category to cover, right? Schemes that center around information manipulation. And I feel like that's a whole other can of worms.
Oh, absolutely.
It's like that old saying, don't believe everything you read on the internet. But with investing, it's more like don't believe anything until you verify it, internet or not.
Right. Trust but verify. It's always better to be safe than sorry, especially when it comes to your hard-earned money.
1,000%.
Yeah.
And speaking of things you might read online, we need to talk about investment newsletters.
Oh, yes. Newsletters.
Because they often try to position themselves as these exclusive clubs with like secret insider knowledge. Subscribe now to unlock our top stock picks, that kind of thing.
Exactly. And while there are legitimate newsletters out there, there are also plenty that are part of what's known as a pump and dump scheme.
Pump and dump. That sounds shady.
It is. Basically, what they do is they buy a large number of shares in a company, often a smaller, lesser-known company, so it's harder to detect. And then they use their newsletter to pump up the stock price, spreading misleading or even completely false information, trying to create artificial excitement around this company.
So they're manipulating the market, making it look like this company is about to take off, and then what happens when people start buying into the hype?
Well, once they've pumped up the stock price enough, that's when they dump their shares. They sell everything at the inflated price, make a huge profit, and leave all those unsuspecting investors holding the bag when the price inevitably crashes back down to reality.
That's awful. So how can our listeners spot these shady newsletters? What are some red flags to watch out for?
One of the biggest ones is outlandish promises. If a newsletter is guaranteeing returns, claiming to have some sort of exclusive insider information, that's a major red flag.
It's like those spam emails promising you'll get rich quick with this one weird investment trick.
Exactly. If it sounds too good to be true, it probably is. Another thing to look out for is a lack of transparency. Do they disclose their track record? Who are their analysts? Legitimate newsletters should be upfront about this kind of stuff.
And if they're being vague or evasive, it's probably best to just hit that unsubscribe button.
100%. And while you're at it, take a moment to research the newsletter or its publisher. The SEC, the Securities and Exchange Commission, and FINRA, they both have databases where you can check for any disciplinary history.
Like a background check, but for your money.
Exactly.
Love it. All right, so we've talked about newsletters, but those online scams are just one piece of the puzzle, right? We also need to talk about those in-person financial seminars, particularly the ones that target seniors.
Right. Those can be especially concerning because they often use a lot of the same tactics. The high-pressure sales, the misleading information, playing on people's emotions.
And their desire for a secure retirement, right? Preying on those vulnerabilities.
Exactly. They'll lure you in with promises of free meals, exclusive insights, personalized advice, but often their real goal is to sell you unsuitable products. It's a sales pitch disguised as a helpful seminar.
So they're using the seminar as a platform to push these products, and they're usually targeting seniors who might be more susceptible to those tactics.
Right. They might emphasize the dangers of not investing or create the sense of urgency, saying things like, "This offer is only available for a limited time."
Classic pressure tactic. Act now before it's too late.
Exactly. But remember, you are never obligated to make a financial decision on the spot, no matter how much pressure they're putting on you.
Take your time, do your research, don't let them bully you into anything.
Exactly.
So for our listeners who might find themselves at one of these seminars, what's the best way to protect themselves?
Go in with a healthy dose of skepticism. Ask questions, lots of them. If something doesn't sound right, trust your gut.
There's no such thing as a stupid question.
Exactly. It's your money. You have every right to ask for clarification and take your time to make a decision that feels right for you.
Okay, so we've talked about newsletters, we've talked about seminars, but there's one more type of information manipulation that we need to address: microcap stock fraud.
Right.
And these are typically smaller companies that we might not hear about as much in the mainstream news, right?
Exactly. Microcap stocks are often companies that have limited assets, a short operating history, and they usually trade on what are called over-the-counter markets, which tend to have fewer regulations.
So less transparency, more opportunity for things to go wrong.
Unfortunately, yes. And because they fly under the radar a bit, it's easier for scammers to spread misinformation, manipulate their stock prices without attracting as much attention.
It's like the Wild West of the stock market.
In a way, it is. And they use a lot of the same tactics, the pump and dumps, using online forums, social media, even spam emails, to spread the hype and lure in unsuspecting investors.
So you're scrolling through your social media feed, and you see this post raving about this amazing company. You've never heard of it, but it's supposed to be the next big thing, and they're urging you to buy now before you miss out.
Exactly. And that's why it's so important to be very wary of any unsolicited investment advice, especially when it comes to these microcap stocks.
So if you see a hot stock tip from some random person online, best thing to do is just ignore it.
Absolutely. Never invest based solely on something you see online or in an email. Do your research. If it's a legitimate opportunity, it will still be there after you've had time to look into it.
Always good advice. If it seems too good to be true,
It probably is.
the golden rule of investing. Well, we've covered a lot of ground today, from emotional manipulation in complex financial products to misleading information and outright scams. It's clear that the world of investing, while potentially rewarding, is also fraught with risks.
It definitely is. But that's why knowledge is power. The more you know about these schemes, the red flags to watch out for, the better equipped you are to protect yourself.
Absolutely. And remember, it's your money. You're the one in control. Don't be afraid to ask questions, do your research, and if something doesn't feel right, walk away.
Couldn't have said it better myself.
Being a savvy investor is the best defense against these scams, so stay informed, stay vigilant, and until next time, happy investing.